if I were to choose 5 ETFs for a long term, how should I approach them?
If you had to invest a fund for the next 30, 40 years, what fund would you buy? I don't know. This fund would be that fund, I would say. This fund, you're buying about 80-85% of the market. Not taking a risk on fund manager. You're buying something low cost. You're not taking a risk on large, mid, small. It has all the sectors. It has all the stocks.
Is there any reason for investor to look at NFO? Is there any benefit?
ETF price is say 100. A lot of ETFs in the market will be trading at 100.5. So you are paying 50 paisa just to buy that ETF.
Hi friends, if you want to master the art of passive investing, then this podcast is for you, because I'm sitting right next to Mr. Pratik Oswal, who is heading the passive investing division of Motilal Oswal. Pratik ji is managing currently almost 40,000 crores of asset under management just in passive investing. So who better than Pratik ji can give us the insight about passive investing? So let's learn from the best in the business. Pratik ji, thank you so much for giving your time. I am extremely thankful, and I'm sure my audience will also be extremely thankful for this conversation.
Thanks, Rahul. Excited for this conversation. Looking forward to, I think this podcast. It's. I think investor education is something which is honestly the most important thing that I do, and these things really, are. I mean, amongst a lot of things I do, this is like the things that I look forward to the most.
Yeah, thanks. And I think that's a very good context you've set up here, that before investments come education, because if you get educated, your investments are likely to do much better. So thank you for that. I want to start with, 2-3 years back, I read this book, Psychology of Money, very, very famous book by Morgan Housel. And he gives so much deep insights about how to manage money, how to control emotions, etc. The book is full of that. And towards the climax or the last chapter of the book, he reveals that he only invests in index funds. So, he's come back to index investing. So, I want to ask you that how much it is important for Indian investors to think about passive investing, be it ETFs or indexes?
We believe that if you look at India today, the reason why index funds we believe are already important and will be even more important is because we believe that if you want to, and everybody I speak to wants to get financial independence,
right?
That is the crux of why people invest. They want to be financially free, and I think they want to be able to live a life where they're able to afford things. Also save some for their retirement, for their kids' education, for their marriages, for their homes. So I think investing, I believe, is one of the most important things that one should spend time on. Sure. In order to learn about it and all of that. We believe that there are two ways of making money.
Right.
One is to do with your job, and the second one is through investing.
Sure.
What we've also seen is that if you look at 99.9% of wealthy people in the world, financially free, there is one thing in common. They have not got there because of their income from the job. They've gotten because, they've made investments. They own something.
Right. Either
they own their own company, or they own equities, or they own gold, or they own real estate. So I think what leads to financial freedom, what most people tend to do is they spend 95% of the time focusing on their job.
Right.
I think that's important, obviously. Having a job is important. That's how you feed into your investments. But, what really creates financial freedom is actually investing.
Right.
And we believe that to be able to be financially free, you have to own stuff. Own anything, but own stuff. Within the ownership model, where you can buy a lot of things, the asset class that gives you the most amount of returns is equities.
Right.
So equities is by far, in any geography across the world, will give you the highest returns. It will beat inflation consistently. It will make you wealthy, and sure. Equity. So equity is the highest returns. Within equities, mutual fund investing simplifies equity investing.
Sure.
So if you want to really simplify, if you don't want to dabble with stocks, which I believe most people should not do. It should be passive. Investing should be passive. Your job should be active.
Right.
The moment you make investing your active, you will not do well at your job, and you will not do well in investing also. So I think mutual funds simplify equity investing. And guess what? Index funds simplify mutual fund investing.
Yeah.
So if you want the simplest and probably the most effective way to create wealth, we believe it's through index funds and ETFs.
Right.
And that's why, I think index funds are very important.
Yeah, right.
The second thing, and this is also extremely important, is that the universe is extremely broad today. आज बहुत सारे options हैं. You have thousands of mutual funds. You have thousands of, investment options, AIF, PMS. So the complexity of the industry has become super high. And I think because of the complexity being high, people are increasingly more and more confused.
Right.
And I think index funds simplify this in a very meaningful way.
Right.
We would like to tell people is that by choosing index funds, you're making your life simple, but you are not giving up on returns.
Right.
In fact, the guys who invest the most in index funds, ETFs, are the most sophisticated guys.
Right.
When we started building the business in 2019, when I first joined and when I came back from the US, we can talk about it later. But what I saw was that my first 10,000, 20,000, 1 lakh customers, were actually not first-time investors. They were extremely advanced investors who've dabbled active funds, passive funds, international funds, and they chose passive investing because they thought that, this is low cost, this is done extremely well in terms of returns, and this is something that you can hold on for 20, 30, 40 years without having much tension.
Right.
So I think it's not something which we believe is for the very new or someone who does not know much. So I think that's also why I think index funds are very useful, because they're a simple way. You don't have to complicate life through a lot of other things. And third is because of low cost.
Right.
I think one of the reasons to why people choose index funds is because they're very low cost. I wouldn't say this is the most important reason.
Sure.
But it is an important reason for people.
Right.
So I think what happens is if you're investing in an instrument that is very low cost, say it's charging 0.2%, per year, which includes everything, transaction cost, this, that. You're essentially putting 98.8% of your money in the underlying stocks. 99.80. Sorry, my bad. So you are essentially getting an excellent instrument that is managed by a professional entity, which is growing at 12-15% a year, depending on what you choose. And most of your money is invested. So there the leakages are minimal. So the wealth creation opportunity that you can have is quite massive.
Yeah.
So these are the reasons to why I think index funds are very useful and why everyone should have some allocation to index funds. The problem is awareness, obviously. So I think a lot of people are not aware of index funds.
Right.
And I think that has also increased multifold in the last 5 years.
Great. So I think you talked about the awareness that it is low right now, maybe, and we could do much better there. So let's say I get convinced with your answer, right? And I say, okay, I'm going to stop doing active investing now and I want to move into passive investing. Okay. And let's say, Pratik ji, I say, I want to build a portfolio for 2040. Yeah. So it's a long-term portfolio. Okay. And I want to have, let's say, 5 ETFs in my portfolio. And of course, the reason I have picked up 5 is that I want a reasonable diversification in my portfolio. I do not want to stick to only one type of ETFs or index funds. So if I were to choose 5 ETFs for a long term, how should I approach this? Because as you rightly said, there is more confusion. Even in index funds now, there are a lot of offerings, right? Yeah. So there's more confusion than clarity.
Yeah.
How should I, as an investor, approach that I need to build a portfolio for 2040 for ETFs?
First, let's look at what ETFs are and what index funds are.
Sure.
I think for the layman, that itself is a problem. Should I buy ETFs versus index funds? And then to answer to that is that it doesn't matter.
Right.
I think you should go with whatever is convenient. What are the differences? Index funds are like mutual funds. You can do SIPs. You don't have to worry about the price on the exchange. You can simply click on a fund and buy it like it's e-commerce. So basically, index funds are more to do with the product and simplicity, and you don't have to worry about anything. Whereas ETFs are essentially index funds that are listed on the exchange.
Right.
So ETFs trade like stocks. You can buy a Nifty 500 ETF in the morning, and you can sell a Nifty 500 ETF in the evening.
Right.
Whereas index funds are more mutual funds where you get the end of day NAV.
Yeah.
That is a broad difference. There's no difference in returns or anything. You should choose whatever is convenient to you, and that's the most important thing. So when it comes to building a 5-stock portfolio for your future, I think there's 2 components to this. One is obviously the product, what comes into this 5 stocks. The second one, this is a more important bit, is the behavior.
Right.
So if you look at I would have, I've been reading about. I'm very lucky. I've been reading about investing in finance since I was 12 years old.
Really?
So,
12 years?
Yeah. My first book was I think when I was 13. First full book.
Right.
Yeah, was when I was 13, 14 years old. And I must have read hundreds of books in investing and finance. And what I've realized is that the product doesn't matter. 90% of your returns are going to be dictated by your behavior. So the underlying product is actually not very useful. That's number one. The second is that asset allocation is a lot more important than product selection.
Right.
What does that mean? That means that if you as an investor want to create a 5 ETF portfolio, which is fine, I think 5 is a very good number. Now, how much of your money goes into equities versus debt versus gold versus real estate versus thematic, whatever it is, that is the most important decision that you will make.
Right.
As opposed to under equities, which is the fund I should buy.
Okay.
So there are long-term studies that have been done on asset allocation. What that studies have shown is that if you look your returns over a 20-year period, which I think most people in India will have a 20-year horizon, 90% of the attribution of those returns do not come from what fund you buy, what fund you sell.
I see.
It comes from your asset allocation. So your decision of putting 60% or 80% of your money in equities versus fixed income versus gold versus international is the most important decision. That will determine what returns you make in 2040.
Right.
So behavior and asset allocation are the two important things. So now I assume that you're talking about a relatively young investor, in their mid-30s. He doesn't have any, he has, he or she has sufficient liquidity for any emergency costs. So they just want to, do
invest for long term and then forget about it. They don't need to touch this money.
For about, say, 15, 17 years. 15 years. So I would say that the best investing would be to maybe, so if you want to, I mean, that person, I would ask him or her to do about 60 to 80% of the allocation to equities.
Right.
So say they are a relatively aggressive investor. So say 70% can be in equities.
Right.
I think which is a combination of domestic and international. And then you can say about 20% in debt and 10% gold.
Right.
That is the ideal allocation, which I think will do extremely well. So Indian equities, I would say maybe put 50%. This is not a recommendation.
Of course.
Yeah, this is just a very broad framework. Maybe 50% Indian equities, 20% international through something like a NASDAQ or some ETF, international ETF. It's simple. Maybe 20% can be in a very good medium-term debt mutual fund or an arbitrage fund, and maybe 10% in gold and silver.
Right.
So I think that's the best allocation. Will do extremely well. It's very low correlated, and when equity markets do badly, you have internationals, you have gold, and you have your debt markets to protect your downside.
Yeah.
Whereas in the upside, you have your Indian markets, you have your international markets, and you have gold.
Right.
So I think this is a very good portfolio to have. I would say this is the best way of, at least, and within equity, as I said, within Indian equities, whatever you buy is fine.
Yeah.
I would say invest as per your risk profile. What that means is that if you're able to take more risk, then put more mid and small cap in your portfolio.
Right.
Otherwise, put 60-70% large caps.
Yeah.
So that's what I would recommend. Any mutual fund is fine. Honestly, what I've seen is most mutual funds tend to give similar returns. What people feel that one mutual fund is better than the other, but that is again also you would look at the last 3 years. Every 3 years you see a different mutual fund doing well.
Winners change.
Change every year, every 2 years. So I would say that don't rely much on past short-term data, like 3 years. Look at good fund houses that you respect, that you admire, that understand what you're trying to do, and expect periods of underperformance and outperformance if you're doing actively mutual funds.
Yeah.
When it comes to passive mutual funds, so this is an ETF portfolio that you asked me. What I would do is, my large cap portion, my ETF, I would have 3 equity ETFs,
right,
which is 1/3 large cap, 1/3 mid cap, 1/3 small cap. Very simple. That's 3 ETFs.
Right.
1 international ETF, that's 4. And I would say 1 fixed income ETF and 1 which is like a liquid or a 5-year GSEC ETF, and maybe a gold ETF.
Right. So
This
that's
is
a very
your
good
5-6 ETFs that I would have in your portfolio, and more importantly is manage your behavior. That's I would say your long-term returns are not linked to what funds you select. It matters on what your asset allocation is, and more importantly, what your behavior is like.
When you say behavior, you mean, for example, if the market is falling, you're not unnecessarily panicking.
Absolutely.
Those are the decisions, or those are the emotions you need to control.
Absolutely. Okay. So, the reason why I say behavior is important. People talk about active versus passive. What gives you more returns? We did the study, not now, but 3-4 years back now. And this, I've mentioned the study many times. That talks about how much the index is done about, say, 12 to 13%.
Sure.
Last 15-20 years, which is very good. And this is a Nifty 50, which is not a very good index, to be honest. Nifty 500 is better. So a very basic index like a Nifty 50 does about 12-13% CAGR. An average investor makes about 7 to 8%.
Right.
So it doesn't really matter whether you're active or passive. Why does the average investor make 8%? Is because they panic. In bull markets, they go all in. Bear markets, they stop their SIPs, or they put in less money. So I think best way to invest is to invest or forget.
You talked about various ETFs, right? Like you talked about large cap, mid cap, small cap, gold, etc. So if I were to pick, so even let's say mid cap category, I'm sure there are more than 15-20 ETFs.
Yeah.
Right? I mean, I don't know the exact number, but I'm sure there are more than 15-20, right?
Yeah, there are lots.
How do you go about comparing these ETFs? Because ultimately, they're doing exactly the same thing. They are following an index. They've got a benchmark. They're trying to be at the same level as index. They have their expense ratios very, very close nowadays, 0.15%, 0.1. How do you go about, like in your mind, how should one approach the comparison?
Yeah, I think there's two comparisons. So suppose you want to buy an ETF or index fund in mid caps. And mid caps, I believe everyone should own mid caps. I think I'll give you the philosophical reason to why you should own more mid caps than before. But let's look at selecting an ETF,
right,
or an index fund in a mid cap category. First is that there are different type of ETFs, different type of indexes. You have mid cap 100, you have mid cap 150, then you have mid cap quality, you have mid cap momentum. So I think I would say investors, for simplicity, should focus on the broad-based indexes like mid cap 100, mid cap 150. It doesn't really matter what you choose. I think the simplest, if you look at philosophy of passive investing, which is buying the market, then a mid cap 150 is like the best fund.
Yeah.
Buy the market. It's done extremely well. It's like, there's the mid cap index. I think there's like maybe 1 or 2 funds in India that have beaten the mid cap index. It's a phenomenal index. And I would say that most mutual funds across AMCs who have mid cap 150 index funds, ETFs, are exactly the same.
Right.
So I would say, number one, choose the asset management company that you trust, that you want to deal with.
Sure.
And obviously, if you're agnostic, then you should look at something called a tracking error,
right,
which is now in all fact sheets. Ideally, the fund with the lowest tracking error is the best fund that you should buy. So I would say that's a selection methodology that you can do. So I would say the simplest is to buy the market, and simplest is to buy the fund with the lowest tracking error, or not lowest, but one of the lowest.
Right.
Honestly, the industry has become extremely efficient in the last 5 years. When I started this business in 2019, I myself would not put money in any index fund.
Oh, really?
Yeah, because they were very inefficient.
Okay.
The expense ratios are very high. They were not managed well. You had underperformance of 1-2%. So because no one cared, there were no regulations.
Right.
I think SEBI has done a phenomenal job of regulating index funds, ETFs, bringing in processes, systems, efficiency. And now I would say index funds are relatively quite efficient. Not all of them, but most of them. So I would say when you're looking at index funds, look at tracking error and look at something simple. That's the best way to go about when it comes to selecting.
Sure. What about the liquidity? We hear that a lot, that in ETFs, one of the important features is liquidity.
Yeah, absolutely. So I think when it comes to ETFs, the most important, I would say, yes, I think tracking error, tracking difference is important. But yes, for ETF specifically, liquidity is super important. Now, what is liquidity now? Now, suppose ETFs are not bought from mutual funds; they are bought from sellers in the market.
Right.
And what happens in most ETFs in India have extremely low liquidity.
Mm-hmm.
By extremely low, I mean like maybe a few crore worth, or maybe less than that worth of volume on the exchange. So what happens is that for investors who are buying ETFs, they should essentially, either look at ETFs where there's good liquidity, or look at fund houses that are able to give good pricing on their ETFs. So what does that mean, liquidity? That means that if the ETF price is say 100,
Mm-hmm.
a lot of ETFs in the market will be trading at 100.5.
Right.
So you are paying 50 paisa just to buy that ETF.
Correct.
And if you have to sell the ETF, to sell it at 95.5.
Right.
So that is called impact cost.
Right.
And that's a problem with ETFs because there's very low liquidity.
Mm-hmm.
You are essentially you have to pay this impact cost for you to buy and sell ETFs. Now there are a lot of fund houses, including ours, where we have our own market making business.
Right.
So when it comes to buying, say, MO ETFs, or maybe some other AMCs, I can't comment on other AMCs. There are other AMCs also who are doing a very good job of managing liquidity.
Mm-hmm.
Some of them have natural liquidity also, but some of them have done a good job of managing liquidity. So choose fund houses that have some sort of strategy in place
Mm-hmm.
for liquidity management.
Mm-hmm.
Because, so for example, if you bought a fund, MO fund, ETF, the impact cost will be 0.2, 0.25 max.
Is it declared somewhere, impact cost?
So yes, so there is something called NAV. You know what NAV is? There's some, which is yesterday's price.
Yeah.
The INAV is the live price.
Mm-hmm.
So when you're buying an ETF, the market, I would suggest to do is to go to the AMC website and look at the INAV.
Right.
INAV is the indicative NAV, which is what the price should be. Whereas the price on the exchange is what the actual price is.
Right.
If there is a big difference between INAV and the price on the exchange, that means the ETF is very inefficient.
Okay.
So I would say one way to lower your impact cost is to make sure that the price on your exchange is similar to INAV.
Yeah,
like
because
20-30 paisa ka difference hona chahiye, maximum.
Okay. So INAV is calculated at the end of the day.
No, INAV is a live.
INAV is live.
INAV is live. So is price.
Okay.
INAV is what is the actual value of the underlying.
Right.
So if you're buying a Nifty 500 ETF,
Mm-hmm.
the INAV is say 100. 100 is the price of buying the entire basket.
Right.
At this point in time, at this minute, or this second.
Right.
Whereas the prices can be anything, right?
Yeah, because that is dependent on the demand and supply on the exchange, right?
Yes.
So if that is higher, so if I am able to catch the exchange price lower than the INAV for whatever reason,
yeah, you can.
Then that's a good bargain for me.
Yeah, if you're able to do so, there are a lot of guys who do this arbitrage. There are already a lot of we including do that. So I think that happens a lot. But normally we see spreads differences of about half a rupee, half a percent. I would say that choose ETFs that have a very low spread.
Right.
So I think that's the nuance with ETFs.
Mm-hmm.
What we've done a lot of research and studies and surveys.
Mm-hmm.
We've done now 3 years of surveys which have got a lot of accolades on passive investing. And what we've realized is that investors prefer index funds. So
because of these complications?
Because of these complications.
Right.
And what has happened is the reason why ETFs are very popular in the US is because ETFs have a tax advantage over index funds.
Mm-hmm.
India, there's no tax advantage.
Yeah.
Both are exactly the same. Index funds are in fact simpler. You don't have to worry about price. You get end of day pricing. You can sell whenever you want. You can do SIPs, much simpler. So I think thus, if your ETFs, the target segment is traders and institutional investors who prefer ETFs.
Right.
Whereas a lot of the retail investors, HNIs, tend to invest in index funds. This is talking from industry experience.
Right.
So I would say if you're looking at doing something simple, again, choose an index fund. It's much simpler.
That's brilliant. Thank you so much, Pratik ji. Now let's move on to the next one, which I myself do not know much about. So I want to, learn from you. NFOs, right? So every now and then, NFOs come into market. And one of the questions that I ask is, shall we look at NFOs or not? Because let's say a mid-cap new NFO comes in terms of an index fund or a ETF. There are already 10, 15 ETFs or index funds. Why should a retail investor, is there any reason for investor to look at NFO? Is there any benefit?
I would say if the NFO is bringing something new to the table, then yes, it makes sense.
Right.
But ideally, people should not look at NFOs. It's not, unless it's something different, as I said.
Yeah, okay.
Unless something different. So unless a new product which is not there in the marketplace.
Sure, of course.
It's something which is people are looking for in terms of I think so. The thing about NFOs is we we are an asset management company which is catering to many clients. We have like 15-20 different segments. So I think the average investor is one of the segments. Obviously, the retail investor. We have institutional investors. We have your HNI investors. We have private wealth firms. We have asset allocators. We have I think so. We have traders. So when we do NFOs, we are trying to essentially do NFOs for a certain target audience. And we are trying to add value to whatever's out there in the market.
Right.
Or we see there is demand coming for this product and we don't have it. So let's just have that product because there is demand for it, which is also a good reason to launch NFOs. So for an average investor, I would say unless there's something already there in the market, there is no need to look at NFOs.
Right.
In fact, NFOs should be very low, should be a way in which you can learn something as opposed to actually investing in it.
Right.
So one of the biggest issues I see with investing with a lot of retail investors is the reliance of many mutual funds. There's too many mutual funds. I think the more you have, the more you have to worry about. I think that the 5-6 stock ETF, the 5-6 ETF portfolio is, I think, great. People should not go beyond that.
Yeah.
Less
is more.
Yeah, I have my majority of my money is in like one fund. Studies have shown that you don't need more than 30 stocks in a portfolio. That is optimum diversification from that asset class.
Right.
And then obviously, so if you have 30-40 stocks, you don't need anything more than that. In fact, what we've seen is that if you have too many mutual funds, say you have 15 mutual funds, which a lot of people have, if you add them up, guess what? Their returns will be the same as the Nifty 500.
So it's better to go with Nifty 500.
Just buy Nifty 500. Why buy 50 mutual funds? Because kya hone wala, if you buy 50 mutual funds, out of that 5 will do well, 5 will not do well, 5 will do average.
Right.
If you combine all of them and take out a single NAV, it will reflect the Nifty 500. In fact, it will underperform the Nifty 500.
Yeah.
I'm pretty confident in most cases. And there's stress. What should I buy more? What should I buy less? What should I sell? What should I buy? The average holding period in India is 1.5 years. Just terrible. It's just really bad. That's what upsets me the most. Now that we have a large business, what really upsets me is the fact that if I have gross inflows coming in, about 40 to 50% of that is something that goes out of the system every day.
Right. So churn is very high.
Churn is extremely high. So imagine if suppose today I'm doing 1,000 crores a month, I'm actually only doing 500 crores. 500 is leaving the system. And that 500 crore leaving system has been around for maybe a year or 2 years, not more than that. So people are profit booking, all of that. So
and why is it so in India in particular? Is there any reason?
Yeah, I think people feel that there's a secret source of creating wealth and you have to do active churning to create wealth. Active churning leads to transaction cost, leads to paying taxes. So I think that's the worst philosophy to have. In fact, this is what I would tell investors who want to do active, who want to sort of be involved and be involved in stuff. What I would say is that do it. Don't stop. Stopping someone is much harder. So my advice to those sort of investors is, firstly, as I said, don't have too many mutual funds, because if you aggregate them, you'll be Nifty 500. Now, if you want to do active churn, which I think you should do it if you want to do it. People have urges. Saying no to urges is very difficult. So do it with a small part. Say suppose you have a 10 lakh portfolio. 8.5, 9 lakh put into this 5-6 ETFs, long term, forget it. The maybe 1 lakh rupees, you can do some active churning, you can do some sort of analysis.
Experiments.
You can do experimentation. If you think you like this sector, this theme, or this particular stock, go for it.
Yeah.
There's a 90% chance that you will not do well, but if you do well, great. That's great.
So that's like core and satellite. Is it similar to that?
I would say no. I would say this is beyond satellite also, because even satellite tends to be long term in nature.
Right.
Core and satellite is essentially, core is something which you won't touch for 20 years. Satellite is say next 3 to 5, 7 years. And then this is basically if you want to take a call for the next 1 year or so, which a lot of people do, by the way.
Quite short term.
Yeah, very short term sort of a thing where you have a thing that मुझे private bank को buy करना, or buy PSUs, or to buy defense, or if I want to buy this particular stock, do it with this portfolio, which is very small, and experiment there. So at least your urges are being met. Plus, you're ensuring that your long-term wealth creation is also happening.
Yeah.
Because of your long-term investment, which is 80-90% of the portfolio.
Coming back to your biases or your choices. Of course, this is not for recommendation, but I would like you to tell us which one is your favorite ETF or index fund as of now from Motilal Oswal.
So our favorite one is very standard Nifty 500 index fund ETF. They are both. So that's like our favorite fund. I'll tell you why it's favorite fund. If you look at, so you know, there are two competing philosophies even within passive investing.
Right.
And this is something which I have recently learned. You know, and it's very interesting. You know, if you look at what passive investing or index investing is, the original philosophy is buying the market. Buy the market, you know, you buy the market and let the market decide where to go. And if you look at the most prominent index mutual fund in the world is S&P 500, which is basically buying the market. So there is one philosophy called buying the market, which is the true philosophy of passive funds. Now the second philosophy is something called active selection.
Right.
Now, what does that mean? Active selection means that you're actively selecting what fund to buy, what fund to sell. You're not buying the market. I want to buy mid cap. I want to buy small cap. I want to buy capital markets theme. I want to buy bank index. I want to buy IT index. I want to buy micro caps. So there is an active selection. The fund is passive, but the selection is active. You're not buying the market. You're buying a subset of the market.
Sure.
Which you think will do extremely well in the next 3 to 5 years. So I think these are competing philosophies. I'm more of a traditional guy. I like the original philosophy of buying the market,
right?
Which is why I like the S&P 500 index in the US and I like the Nifty 500 in India.
Right.
These two are like the best funds that you could buy in your portfolio. I think they would outperform most funds in the country. They've done extremely well, 13-14% CAGR over the last 15-20 years. If you had to invest a fund for the next 30-40 years, you know, what fund would you buy? I don't know. This fund would be that fund, I would say. And lastly, I think you're buying the market. You know, this fund, you're buying about 80-85% of the market.
Right.
You're buying large, mid, small, you know, and essentially you are not taking a risk on fund manager. You're buying something low cost. You're not taking a risk on large, mid, small. It has all the sectors. It has all the stocks. So essentially, you're not betting on anything. You know, what's really interesting about this fund is that this is the one fund where, you know, surprisingly, there are no outflows. You know, we had a very good analysis about last year, is when we are like, you know, this is the one fund where, you know, outflows are they're there, but they're very limited. You know, other funds have a lot more inflows and outflows.
Okay.
So we're like, why is that happening, you know? And we did some research, you know, we spoke to a lot of investors and, you know, I spoke to a lot of distributors also, you know, who are selling our Nifty 500 fund and asked them that, you know, this is a very good fund, obviously, it's our favorite fund, but, you know, we see that this fund has very low outflows. And, you know, we got very good responses. You know, what people said is that, you know, when you're looking at buying mutual funds, any mutual fund, you are betting on something. You know, you're betting on large caps, you're betting on mid caps, you're betting on small caps, you're betting on multi caps. You're betting on, say, some sector themes. You're betting on this AMCs. You're betting on this investing philosophy of this fund manager to this fund. When it comes to Nifty 500, you're not betting on anything.
You're betting on India.
On large caps. Yeah, you're betting on India.
You're betting on India. If India grows, so economy grows, markets grow, and that's where you're betting.
That's basically, so we're like, you know, if small caps do badly, theek hai. If large caps do badly, theek hai. If some sector does badly, theek hai. This will always grow. So I think that is like one of the most insightful things that I've learned about this broad-based benchmarks, and which is why I feel like it's one of the fund which I would say that if you buy it, there is no reason to sell.
Right.
It's not a recommendation again.
Of course.
But all I'm saying is that this is the insight that we've gained. And that's why we like these broad-based indexes. You know, we launched a BSE 1000 index fund a few months back, which is top 1000 companies.
Right.
I think it captures some 90% of India's market cap. Very interesting fund. Again, very similar to Nifty 500. But all I'm saying is that these broad market fund like S&P 500 in the US. It's such a landmark, it's such an iconic fund. It's been around for half a century. It was launched in the 1970s by, I think, Vanguard or something. Not Vanguard, by someone else. But I think it's such an iconic fund. It's been around for half a century. Nobody knows a fund that's been around for half a century. And it does well.
I think this has got the largest market cap also, if I'm not.
Yeah. So top 3 out of 5 of the largest funds in the US are S&P 500 funds.
Yeah.
It's huge. So it's like you have to have S&P 500 in your portfolio. So I think the Nifty 500 is like that. And that's why it's our favorite fund.
Okay, great. No, thank
Unfortunately, it's not an exciting fund. So, we don't see as much traction as some of the other more exciting funds.
Right. With that, let's move to our last section, which is going to be rapid fire. I'm going to ask a few questions, give you 2 options, and you have to select one of them. Some of them might be some personal questions as well, whatever research I've done, a little bit. So, with the first one. So, who has had deeper influence on your career? Is it your dad, Mr. Oswal, or Ramdev ji?
My dad.
Your dad has. Brilliant. There's an ongoing debate on social media about buy a house or rent a house. What's your view?
I mean, it's a very personal thing. So I would say, house is something which is an asset where you're actually using on a day-to-day basis.
Right.
So I think I think house should not be under the category of a financial
asset. Okay.
It should not be. It should be different.
Right.
So I think whatever gives you peace of mind.
Right. Brilliant. For long term, better choice, ETF or index? I think you sort of clarified it. Fourth one, Indian tax system. Is it, or rather Indian taxes, you think they are justified or not justified for the facilities we get?
I think they're justified, but obviously we need more accountability in the system,
right,
which is not there.
India or US stock market, which is looking much attractive as of now?
India.
Large cap ETFs or mid cap ETFs?
Mid cap ETFs.
I think you talked about that as well.
Yeah. I can talk about why mid cap ETFs.
Please do.
So it's very interesting. If you look at the regulated definition of mid caps, it's fairly odd in India. It's stock number 101 to 250.
Right.
Top 100 stocks are large caps, 101 to 250 is mid caps. The problem with the definition is that the average mid cap company has grown by 4 to 5 times in the last 7 years.
Right.
So the mid caps of an average mid cap company today is like 40, 50, 60,000 crore market cap, which is not really mid cap, it's large cap. They are like yesterday's large caps. An average small cap company, when we launched our small cap index in 2019, was about 4,000 crore. Today, an average small cap company is 20, 25, 30,000 crore. It's not really a small cap company. And this small cap company will become 1 lakh crore in about maybe another 7 to 10 years. That's not a small cap company.
Sure.
So I think for you to, and the returns are going to happen in smaller companies. So I would say if you're buying a mid cap fund, you cannot associate the same risk as you did to mid caps 10 years back.
Right.
People say mid caps are more expensive, more risky. I was like, no, an average mid cap company is bigger than an average large cap company 10 years back.
Yeah.
So actually, you cannot associate the same risk. So I would say an average investor should actually increase the allocation towards mid and small caps because the whole category has become less risky because how big the companies have become. So I would say an average investor should actively look at more allocation towards mid and small because that's where the returns are and that's where the risk has come down significantly compared to what it was 10 years back.
Yeah.
Because of its depth. So if you look at the US, the top 80% of the stock of the equity of the stock market is large caps. In India, large caps are only 58-60% of our equities. It used to be much higher. And large and mid cap would be about 80%.
Right.
Essentially, in India, top 250 would ideally be large caps.
Yeah.
So that's why I say invest more in mid and small caps.
So does it mean that the top 50 companies, because of the sheer size of them, have become quite slow to grow? And is that what is...
Absolutely. So top 10 companies, top 50. So the problem with Nifty 50 is that you're putting 60% of your money in the top 10 stocks. I don't think, and those are large companies. I'm not doubling that will be tough. So I think if you're looking at, say, stability, then obviously it makes sense.
Of course.
But if you're looking at, say, stable 10 to 12% returns, Nifty 50 is good now. But if you're looking at, say, slightly higher return profile, you should go beyond Nifty 50.
Yeah. Okay, no, understood it. Thank you so much for that. Traditional ETFs or smart beta ETFs?
Traditional ETFs.
Traditional ETFs. Okay, my last one. Can Nifty hit 50K by 2030?
By 2030, I'll have to run the math.
So this is like
what compounding is that?
5 years, and it needs to double. So
Yeah,
around 14%
absolutely,
CAGR.
absolutely.
14% CAGR. You're confident? Yeah. Brilliant. Okay, that's it. So I thoroughly enjoyed it, Pratik ji. I'm taking a lot of insights back, and I'm sure I'm going to reflect back, and my audience would have got a lot of education out of it. None of this is recommendation here, of course. You guys know it. Our intent is to bring you insight from the industry veterans, and who better than Pratik ji could have given us insights about ETFs and passive investing. I hope you enjoyed it. If you did, like this, and I look forward to seeing you in my next one. Keep rocking.